Analysis paralysis. It's a thing we all have when we're getting started in our investment journey. It's whether to go left or whether to go right. It's whether to take that deal or go down the JV path or buy a property, buy our own home, rent vest. And there is so much media which is pushing us in so many different directions. We've got Manas coming on the line very soon, and I'm really excited to answer his question, to give him a lot of direction of what he needs to be doing next. He's got so many different options, and it's weighing up which direction he needs to go to and understanding all the various different things that he did not know. And we're going to be talking about capital preservation. We might be discussing and chatting about risk mitigation, whether he buys his own home or goes down the rent investment path. So I'm really looking forward to sharing this story with you all. And if you've got a similar story, don't forget, if you wish to get on board with the show, just put your comments in the show link below and tell us a bit more about your story. And we could be getting you here on the show where I can answer your questions and hopefully get you moving in the right direction. This is what school should have taught you. I'm Jeremy Iannuzzelli. So right now, let's get in the phone call with Manas from New South Wales and help him get out of his analysis paralysis and hopefully get him in the right direction, dealing with the right people so he can get his investment journey started.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
We've got a fantastic caller here today and a person who's listened to our show in the past, Manas from Sydney, and he's got some personal journey questions he would like to ask. He's wanting to start in his investment property portfolio journey. He wants to get going in this space, and he's got a lot of questions around what he needs to be doing from a structure perspective, whether it's buying his own principal place of residence, JV deals. So really looking forward to assisting Manas moving forward. But Manas, we have you on the line, mate. How are you today?
I'm good, Jeremy. How are you doing
Mate,
today?
Very well, and I would like to thank you. I know just prior to getting you on the show, I know you booked a room, a private space inside your office today for this. So, mate, I really do appreciate you coming on board.
Thanks, Jeremy. It's my pleasure to talk to you.
Lovely. Well, mate, we'll get straight into it, especially for our listeners, because your question is something that I get a lot of times, many times throughout a week and countless times throughout a year. So if you just want to share a bit about Manas, what you're wanting to know today, and hopefully we can get you on the right path moving forward.
So, Jeremy, I'm a newbie investor, so I want to start my investment journey. Currently, I have no PPOR or investment property, so I'm contemplating a couple of options like doing a joint venture deal, basically buy a acreage land, subdivide, build properties and sell it, or maybe do a buy and hold, buy interstate investment property, buy and hold, and build my portfolio. So there are 2-3 options I'm looking at. I just want to understand what are the pros and cons of each option, what are the risks involved in each of the options. A newbie investor like me, what should be the best possible option at this stage to go ahead with it, and what will be your suggestions and guidance for me?
Beautiful. So one of the crucial parts of anybody's journey is what road to take. There's so many different roads we can take to get to a certain destination or a certain income figure, and it becomes really challenging, and you kind of get this a bit of paralysis, or they call it the analysis paralysis, because we don't want to get it wrong, and if we do get it wrong, how far will it set us back? And there's all these alternate ways to invest or alternate ways to do something. What's right and what's wrong? And really, Manas, there's no right or wrong answer. It's just how equipped and prepared you are to deal with the pros and cons or the issues that you may face in your journey. But what I want to do is I want to just build a bit of a platform of yourself, and then with that we'll be able to move forward. So at the moment you said you've got no current investment properties, there's no principal place of residence, is that correct?
Yeah, that's correct.
And you're currently working full-time or working for yourself as a self-employed business?
Right, so I'm working full-time.
Full-time. And roughly what's your income range? Is it between 100 to 150,000, Manas?
More than that. So
Beautiful.
I get paid around 162 plus
62.
super plus 20% bonus.
Beautiful. So it does put you in a very high income earning position, which is fantastic. Now, you married with kids, mate, or single?
So I'm married. My wife is also working. I have 2 kids. My wife's income is around 115 plus super.
Beautiful. So combined, you've got roughly about 270,000 plus super plus your bonus, which puts you in a fantastic position from an income point of view. Now, I'm going to ask a question, and I think it's a very personalized question, but very important that any investor needs to answer is, what's important to you, Manas? Is buying your own home one of the most important things you want to tick off your list, or you're comfortable to rent vest for a while, build up your wealth before you settle down in your own home?
So I want to go to the latest option which you just told. Basically, invest in properties at this stage,
Yep.
basically rent west or invest in other avenues
Yep.
and build my portfolio. And in due course of time, maybe next 2 to 3 years, I want to buy a good principal place of residence.
Beautiful. So a bit of delayed gratification. Manas, what he's trying to achieve is he's trying to give himself every opportunity to borrow as much money as he can for investment purposes before putting owner-occupied debt, which unfortunately doesn't help us with the bank or lending. Now, Manas, you need to make sure that you're working very closely with a mortgage broker in identifying these goals, because one of the things that I do see as a bit of a con when you go down the rent investment strategy wanting to buy your own home is that you may borrow yourself out of the market. So you may put yourself into too many deals where it's got a long exit that you need to take to eventually sell the property, or you may, borrow too much money and therefore you don't have enough potentially to buy your own home. So you need to make sure you're getting that strategy right. You need to make sure that you're looking at properties which potentially have a good exit in those 3 or 4 years, or you may want to leave yourself enough room so that you do have enough borrowing capacity to buy your own home at the price point that you wish to. So just keep that in the back of your mind as you're starting to build your portfolio going down the rent investment path. You either want to leave yourself enough borrowing capacity to buy your own home in that 3 or 4 years' time, or the investments that you invest in or purchase, you want to make sure you give yourself exit strategies so you can exit the deal, pay a little bit of the tax, unfortunately, Manassas, we need to pay, but then have this big chunk of cash, a lot more than what you have hopefully today, to enter into your own principal place of residence. Now, you mentioned about wanting to go into a couple of different ventures from a buying perspective. You talked about acreage land and potentially the subdivision, or maybe the buy and hold strategy. What's your experience? Have you done any development courses, or have you been or partaked in any subdivision deals with friends or family or associates at all, Manas?
So I don't have any experience in any joint venture deals. So I am in touch with another person who has been doing all these joint venture deals with a bit of markup costs, project management fee for last 7 to 8 years. So in hindsight, I trust him, but I'm still a novice in this field. For buy and hold, I am currently doing a course and I've not completed it, but it's work in progress.
Beautiful.
So that's the state I'm in.
Beautiful. Well, a couple of things that I would like to suggest to you is all about capital preservation. When we invest in property or when we invest in any investment, our first and foremost is always about capital preservation. We want to make sure that we don't lose our money. It's not the end of the world if we don't make the greatest level of return. Sometimes we can live with it. What deters us, just to say, from investing in the future is when we've been bitten, which means we've lost a bit of money, and it really makes a sour taste, especially moving forward for future investments. Generally speaking, you need to make sure, and an investment guideline across any investor will tell you, your goal is to make the most amount of money from the money that you invest, ideally in the shortest period of time, with capital preservation at the forefront of every deal. Now, going down the joint venture path, unfortunately, what it does do is it starts to add a lot of complexities, Manas. You start to potentially be involved in their borrowing as they are with yours. Security, cash flow becomes an issue. Who pays the interest? Obviously, the skill of the person that you're doing the deal with and the exit strategy involved. Who bears the risk? In many deals that I've seen that have gone bad, unfortunately, the person who's put all the money is the one that's lost all the money, and potentially the person who's running the deal just had very limited exposure. So you've also got to make sure that there's enough skin in the game for the other person to have a tangible loss if things do go bad. Because I do see when it's obscure in one person's direction or the other, we do start to see a lot of issues. So capital preservation and risk mitigation is always key. Going down the buy and hold path for your first couple of properties where you're in the driver's seat, Manas, would probably be recommended across many different professionals. And the reason for that is you can dictate, you control what properties you're buying, you control the exit of those particular properties as well, and you really are starting to limit or mitigate as much risk as you possibly can. What you need to have a think about, though, especially if there's an exit strategy for these particular investments in the future to build up enough capital to have a significantly lower debt on your own principal place of residence, is a business plan for all of your properties which you're going to buy and hold. Because there's an old saying, everything's for sale at the right price. So if you can buy a couple of properties where there's a bit of an X factor, and again, X factor can range from the ability to maybe subdivide yourself, where you can pay someone the services to do that, or you can do a granny flat, or you can do a minor renovation. You could be buying in a growth area which has a significant level of growth over the next 2 or 3 years, much like what we've seen in Western Australia and parts of Queensland as well. So if you've got that opportunity through the education that you're currently doing, and you can buy some really good quality property that gives you an opportunity, as I mentioned, to extract some equity to continue the growth, or exit from that property to buy your own home, that might put you on a better starting point than potentially going into a joint venture or an acreage subdivision. Typically speaking, Manas, the clients that I've got that have done that, unfortunately really failed their first couple of times. Now, they were very lucky to walk out with their pants still on in most circumstances, which means they're able to bounce back strongly. But they learned so many different things. And one of the key attribute that they learned was they were never going to go into another deal where they didn't have absolute control. Because their words to me was, Jeremy, this failed not because the deal was a bad deal. It failed because there was too many chefs in the kitchen. There was too many people trying to make decisions in different directions, which unfortunately stalled the development. And by stalling the development, it cost them a substantial amount of money in holding costs, which, they found it lucky to exit at the time they did. So that could be something for you to consider. You don't want to go too aggressive too early. Sometimes you, as a new person into the investment space, you want to just keep things as simple as you can. More simple you keep it, more control that you potentially will have, with capital preservation at the forefront of your mind. That's where you start to get into the realms of potentially a really good investment. Is your plan, when you're looking to buy your own principal place of residence, Manas, are you planning on doing that with loan, or are you planning on trying to reduce as much debt on your own PPOR as you can?
Basically, I've not thought too much ahead in time at this stage. So I was thinking to build my portfolio at this stage, and once I have sufficient equity, maybe just buy the principal place of residence just with equity, not putting too much from my own pocket. That was my thought. But again, things can change in like 2-3 years. I don't know what will happen in due course of time.
Can be done, but just be very careful, because when you extract equity out of your investment properties, the portfolio that you've bought and hold, what that essentially means is that debt that goes towards the equity, that goes towards the purchase of your principal place of residence, and you'll get another bit of loan, probably an 80% loan from the bank to balance off the books. What you do have is then 100% non-deductible debt against your own home. And why I say 100%, you've borrowed, say, 80% from the bank, and the other 20% has come from equity of your investment properties. So what that means is you might have a very large non-deductible debt against your principal place of residence, even though you've extracted equity from your investment properties. So it's always key to note that that money you've extracted for the investment properties, if the purpose of use was for personal purposes, the interest is not deductible. So you've got to make sure that you're factoring that in, and you've got to speak to a broker on that, because generally what you'll find is that if you're extracting the equity out, it may significantly impact your borrowing capacity, which would stop you from continue your property journey in the future, especially if you've got a very large debt against your PPOR. So what I would suggest you do is have that initial strategy session with the broker to chat with them about your goal of buying 1 or 2 or 3 properties, and then ultimately your own home, and what that will look like for you to get there. Because the last thing you want, as I mentioned very earlier on in this conversation, is you don't want to get into a position where you can't borrow to buy your own property. You've essentially borrowed yourself out of the market to buy your own property. That's where you'll find yourself having to panic sell your investments and potentially not getting the best price for it. So that strategy from a lending perspective is going to be so important. The joint venture deal, though, I don't disregard it or discount it. I've seen lots of people make some really good money going into joint ventures, but you've just got to look at all the due diligence for how long your money's tied up, what's the leverage around it as well, the percentage of the level of return, and the various different exit strategies, and most importantly, the risk. How much risk are you taking on in going to this JV deal, and what's the level of reward around it and the timing perspective? So they're probably the couple of things that I would suggest that you want to have a look at. Now, a couple of the other things that you sent through as well is that you're after, the ability to potentially have about $120,000 passive income. Does that sound about right from your earlier discussion, Manas?
Yeah, that's what I was thinking, Jeremy. So maybe in due course of time, like 6-7 years, I want to have a passive income of around 120 plus, or 120 or above, and maybe retire from my 9-to-5 job maybe do something part-time or do something which I like.
It's that liberation of working. It's going to work because you want to, not because you have to, isn't it?
Yeah.
Okay, so some back of the envelope calculations. Now, these are very rough, just to give you a bit of an understanding or an idea of what your level of asset base will need to be. If you're after about $120,000 income, that would in most cases, Manas, represent roughly around about 80% of the real income that's required, because you'll have things like council rates, water rates, insurances, property agent fees, repairs and maintenance. So what I generally do is I divide that 120,000 by 80% and then times it by 100%. So roughly that's going to give you around about $150,000 of actual gross rental income that you'll need. So you'll need to build up your portfolio to achieve about a $150,000 gross rental income. Now, on average, as an investor, a ballpark, pass mark for a property is around about a 5.2% return. So what that means is for us to get $150,000 of gross rental income, we now will divide that by 0.5. And that's going to give us about $3 million worth of unencumbered assets, achieving a 5% return. Take away 20% of it being costs, council rates, water rates, insurances, etc., leaving you with about $120,000 of what you call net income, which you'll pay a bit of tax on, of course. Your goal needs to be to achieve 120 grand. Your goal needs to be, Manas, about $3 million of unencumbered property portfolio or unencumbered assets. What you do is you need to now share that with your broker and say, well, how can I get to my first goal of at least getting to $3 million worth of assets first? Then your second strategy becomes, well, how I pay the damn thing down. And that's where you've got to start to work with various different professionals about investing in alternative investments. Could be looking at maybe holding your portfolio for an extended period of time, maybe selling it or selling half of it and paying the residual balance of debt with the profits you've made, obviously less some tax, and that's going to give you ultimately your $3 million portfolio, 150 grand gross income, less expenses, 120,000 net. Is it achievable in the next 6 to 7 years? Everything's achievable. Is it realistic? It'd be a little bit tough considering you're starting with your first property, hopefully coming very soon. I'd probably say that if you conservatively stretch that out to maybe 10 years, I think you'll definitely be able to achieve your $120,000 passive income goal with the right people around you, the right purchases that you make, and obviously the right guidance from various different directions, whether it's friends, families, financial planners, mortgage brokers, property professionals, education, accountants as well. So I think if you can stretch that out a little bit, become quite selective with the type of properties that you want to buy, have multiple exit strategies, to maybe move into getting your own home at a very reduced debt, and finding quality properties where you can either hold long-term or short-term, and then accompany that with potentially a little bit more riskier deals, again, completely up to you and the due diligence that you partake in. That's what's going to get you where you need to be. But I think getting that team around you, getting the education piece done really well, some friends, good mortgage broker, a great financial planner is always key in everybody's professional team, and a really good accountant. If you can get those people all humming around you, that's going to give you an opportunity of getting you where you ultimately want to be. I'd say to draw a line in the sand, your best bet would be to go into an investment where you've got control, where you can mitigate as much risk as you can, and obviously have capital preservation at the forefront of your mind, and potentially going into maybe your own investment property, as you suggested earlier. That's a buy and hold strategy. Could be a really good start to get you off the line and get that momentum going.
Makes sense, Jamie. I think all of that which you told, I think makes sense and resonates with me.
Beautiful.
So I think at this stage, probably it's not worthwhile to take huge amount of risk and go bang. Maybe take a slow and steady approach, and later point of time, once I gain some experience, then go into joint venture deals and things like that.
Absolutely. And there's a very strong income that both yourself and your wife have. You do put yourself in the very top household income earning families of Australia. So it's the good decisions you make from now, Manas, that are going to take you into a new level in your property or investment journey in general. And I look forward to inviting you back on the show after maybe buying your first 1 or 2 properties, Manas. If you're interested, it'll be fantastic to hear about your progress over the next 6 or 12 months as you start to go through your journey. And thank you very much for your time today. It's been an absolute pleasure having you on board, and your question resonates with so many questions I receive from clients and people in general about where to start and the different crossroads that we have. So Manas, I'd like to thank you very much for your time, and we wish you all the best with your journey moving forward.
Thanks a lot, Jeremy, for taking time to talk to me and providing me all the golden nuggets and all the right guidance.
More than welcome. Have a lovely, lovely day. Thank you very much.
Thank you. Bye.